Hi everyone. Today it's October 13, 2023, and this October we're going to be talking about the bloodbath on branded consumer staples. Is it a buying opportunity? We're going to be talking about companies like Hormel Foods, Coca-Cola, Pepsi, Hershey's, and McCormick Spices. So let's begin. Okay, Okay, let me share my screen here. Okay, so, dividend investing is one of the easiest ways to add passive income to your life. It is essentially making money while you're sleeping. That's why a lot of investors love dividend companies. Dividends are payments made by companies to shareholders in the form of their function of their profits, with a payout ratio ranging from as low as, well, there's no ratio, but usually it's around 10-20% for those that are consistently paying, and then sometimes as high as 90, even more than their earnings per share at times. Dividends can be paid out in different ways, like cash or stocks, and investing in dividend payments is a way to add regular source of income to your portfolio. This is one of the reasons why very long-term retirement income portfolios are heavily geared towards dividend income stocks. Now, there are several people who have personal finance goals, and this class may be one of those times to remind us that number one, buying stocks on a monthly basis, saving 20% of our income, investing in dividend stocks is one of the ways to actually create some really long term gains over time. So, dividend investing, again, is a strategy of buying stocks that pay dividends in order to receive a regular income stream from your investments. This income is in addition to any growth in your portfolio as its stocks or other holdings gain value. So, normally, the way to choose the best dividend income stocks for you is the ones that are the ones that have consistent cash flow, not necessarily the highest of dividend yields, but the ones that can grow their income and dividend payments over time. So what you're looking is consistent free cash flow, number one. You're looking for impressive histories of dividend growth as much as 25 years or 50 years if you can. And these are, again, low risk stock options suitable for retirement portfolios. In effect, these stocks are called low beta, low volatility stocks, and usually are alternatives to bonds. And recently, because treasury bonds, have been giving as high as 5%, have become the go to play of safe haven for most of these long term investors. And that's the reason why we're seeing a lot of staples under pressure and under a bloodbath recently. But this picture is something that I want to share to you. Actually, today, most consumers are bombarded with hundreds, thousands of brands, but way too small number of companies actually own all of them. So, in fact, for most of your household and products, you're actually in a monopoly. And if there's a magnificent seven in terms of technology, when it comes to consumer goods and staples, you actually have magnificent 11 or magnificent 20 stocks only. So you're only talking about companies like Procter and Gamble, Unilever for household products and detergents. You only actually have a handful of companies like Coca-Cola and Pepsi for your beverages and your snacking needs. You have companies in the chocolate space like Nestle, Mondelez, Hershey's, and Mars. Very few actually. And then you've got in realm of snack foods again, or canned goods and frozen meals. You've got companies like General Mills. You've got companies like Kraft Heinz. You've got companies like Conagra Brands. And recently, there was a breakup of Kellogg's, which also has a lot of these snacks. So, in general, you have an illusion of choice. You may think that you have thousands of companies that you're actually patronizing, but in reality, you are just in a handful of 20 companies that are monopolizing your everyday choices of food and drink. So even for Halloween season, which companies do you devour first? The truth of the matter is that it doesn't matter whether you choose Snickers, Milky Way, Maltesers, Twix, or Hershey's or Almond Joy. The point is that most of these companies are just owned again by just four. You've got Nestle, Mondelez, you've got Hershey's, and you've got Mars Incorporated. But that is actually a good thing because as investors, you're actually getting the large market shares or the large companies, and you can consistently predict that every Halloween season, these four companies will always generate that revenues in the realms of billions. So let's talk about the beta or the low volatility. Again, what's interesting about the consumer staple, as you'll know, is when you go to the finviz.com, most of the consumer defensive stocks actually have very low beta or below 1. So when you say that you have a zero point 0.2 beta for Hormel Foods and General Mills here, GIS and HRL actually have zero point 0.2. What this means is that even if the markets go up or go down, they generally would have to move zero point 0.2 of that. So let's say the market or the beta moves 1%. A zero point 0.2 beta means that the stock will move 0.2% either up or down, which is why with most of these stocks having low volatility in a historical manner, say 10 years, 20 years of trading data, the recent movements of these consumer staples going down 9%, 10% in a single day for Hormel Foods is an anomaly. So let's talk about the dividend kings and the dividend companies. You don't get to be a dividend king without being a part of the S&P 500 and without having 50 years of dividend growth. So being a dividend king, first and foremost, is an elite. You have to be a company that got listed and paid consistent dividends for 50 years. How many companies do you think are getting dividends for 50 years? Nowadays, last night Hormel Foods got killed 9 days of a union wage increase of about 3 and their income, and actually might even lay off some people if the company cannot afford raising those wages at the time where consumers are actually pinching their pockets because of very low consumption next few years, possibly on a slowdown in the economy. Then again, as I said, these companies and brands have transcended time. Take note that General Mills, for instance, owns companies like Betty Crocker, Trix, Annie's, El Paso, Kicks. These are Cheerios. Whereas PepsiCo, for those who are snacking on goods, you have been snacking on Lay's, Doritos, Tostitos, Ruffles for almost more than 50 years. And it's likely to be your go to snack chip once you go to the supermarkets next 10 years as well. So we actually have a trivia that you may not know of. For those who were buying coffee ready to drink tea from Starbucks from the supermarkets, you're actually purchasing from PepsiCo. Since 1994, PepsiCo had a distribution deal with Starbucks such that these drinks are actually getting revenues by ownership of Pepsi. So you've got companies like Lipton Iced Tea. You may not know that. Some people may not know that Gatorade is owned by Pepsi, Tropicana, Aquafina, Quaker Oats, and the likes. So there are, of course, powerful portfolios that will capture opportunities. Take note that for Coca-Cola, again, most people may not know, or you may know, Coca-Cola owns Costa Coffee, Coca-Cola owns Dasani, Minute Maid. When you're going to Lemon Toad, that's owned by Coca-Cola. Of course, Coca-Cola owns a lot of companies, Minute Maid, Vitamin Water, and the total industry of hydration, sports coffee and tea, nutrition juice, dairy and plants, energy and emerging drinks. You're seeing that those high growth areas, Coca-Cola also has a market share on them. So it's not just about soft drinks. So, consumer staples in general, in case you have to understand these dividend payment companies, those that have existed and been dividend kings are the usuals like Walmart, ExxonMobil, McCormick Spices, J&J, McDonald's, Kimberly-Clark, Hormel Foods, Clorox, Colgate Palmolive, Con Edison. Because these companies are so large, I wanted to highlight them because some of them are actually selling off in just this week by as much as 10 to 20%, which I think warrants an attention for a potential buying zone. Again, dividend kings, we like them because they are an elite group of companies that have raised their dividends. So not only do these companies pay dividends consistently, they've raised their dividends over the years, which is any company can do. So being a dividend king is actually a very, very strong buy filter criteria. And these companies are, of course, favored because even during recessions and financial storms, they have stable cash flows and they've shown it over that span of time. So usually low volatility, impressive track records. In terms of resume in a company, these have consistently just passed flying colors. And that's the reason why, in terms of valuation, for almost 50 years as well, they have habitually traded at very rich premium valuations because they are considered one decision stocks, i.e., you either just buy it or buy more. Most people don't have sell ratings for these. Investing in consumer staple stocks would include daily essentials, food and beverages, personal care products, household home care products, paper goods, alcohol, tobacco, and cosmetics. You buy them regardless of the state of the economy, and the amount you buy is relatively fixed in good times and bad. Usually, if it's really bad times, you might actually cut your spending, but as much as possible, your cut down on your spending, say on your spam or your bacon for hormel foods, is going to be less. Now, if you're a habitual smoker, you probably will still smoke, but you're just going to smoke less. So we see that these companies are relatively resilient in terms of price elasticity and demand. So our main buying thesis for these is number one, there is an illusion of choice, but actually all consumers are essentially spending on monopolies. And from an investing perspective, we actually want to buy these monopolies that are they are actually producing everything or almost everything that people eat, drink, and use whenever and when the price valuations has come down. And nowadays it's coming down due to the narrative of number one, consumers are actually spending on monopolies. Number two, there is a narrative of high wages, which is just passed. You've got higher wage growth. You've got higher wage growth. You've got a potential margin compression. Actually, not potential because sugar, chocolate prices, cocoa are very high nowadays. Commodity prices are expensive. These are all real. But in our view, these are short-term real bad news. Inflation just came out last night. CPI report was increased by 0.4% yet again quarter on quarter. So you're actually seeing that these bad news consumers are slowing down and their purchasing power is also having a hard time to increase. Therefore, if a company is trying to pass on these inflationary wages, wage growth, and commodity price increases through their selling price, these price increases will have a capped upside. I mean, you can't actually keep on increasing your Coca-Cola by 20 to 30% over time without seeing a huge volume decline. Nonetheless, we think that these will also be capped. No, so it's not going to be forever that these high wages will keep on increasing or the commodity prices. So in our view, for October, November, and possibly December for this Q3, Q4, consumer staples will actually bottom and are in the process already of bottoming out. Because again, while American consumers are cash strapped, or you can argue not Americans but the global consumers are cash strapped, we do believe that we will continue to eat bacon, spam, Skippy's peanut butter, for instance, for hormel foods. And I doubt if every American and anyone in the world will even know that hormel foods is actually having wage hike increases, and that the stock is actually trading at the largest price drop since 2008 financial crisis. I don't think that every consumer is aware of the stock even trading in New York Stock Exchange. Not everyone may know that these companies like spam are traded and can be bought. Number two, I also believe that treasury yields cannot keep going up. Unlike proven brands who can exhibit 10 to 15% price increases over time to continue paying out that nice dividend and earnings. And I am of the view that people will dollar cost average starting last night, starting these past few days. Same reasons for Coca-Cola, Pepsi, Lay's, Doritos, Cheetos. I believe that rate hikes are peaking or somewhat near the peak, and the next 25 basis point hike for November and December are not going to be um, detrimental in terms of these company valuations. In fact, any capitulation or panic selling is actually going to form the capitulation bottom for the consumer staples group. So some of the companies in my watch list or buy zones: drinks and chips, Coca-Cola and Pepsi. I have also a watch buy list on McCormick Spices, MKC. I think it's trading currently at 60. I'll be interested at about $50 today. So it's in the cost average zone. Usually my 25 for the Pepsi is actually trading at 160, $158 today. So it's in the cost average zone. Usually my view is that you will not be able to buy at the dirt cheap price that you want because these are consistently paying companies, and any rhetoric and any narrative might actually be just a headline short-term number, and actually there's more people in the sidelines that's looking to buy these stocks and dips. The other companies that I'm also watching for a potential buy zone is Hershey's and Mondelez. For Coca-Cola, I hope that there's a buying entry somewhere at the 48 to 45 zone. We'll see if that happens. Hershey's, I'm looking at the 160 to $170. And drops. Tyson and Hormel Foods. Actually, last night, Hormel Foods trading at 32 is already intriguing, but we'll see if we can get in at $30 tonight. Tyson Foods is trading at about 45, $46. That's also in the buy zone. Both of them are actually trading at 2020 COVID lows. Hormel Foods is already trading at 2018 lows. So there are actually interesting price levels already for these names. Um, yeah, so again, we're watching them for bottoming out phases for their defensive cash flows. Okay, so Hormel Foods is an uncommon global branded food company. You see that they have retail with 65%. Their brands are Spam, Skippy, Planters. They bought the Nuts brand a couple of years ago, and then actually just 2 years ago, if I recall. But yeah, so and then you have food services, and then you've got the international brands. So everyone in the Philippines should be aware that Hormel is actually being distributed by San Miguel in the Philippines. Okay, so you've got Hershey's, as we said also last week. We highlighted Hershey's because we want the companies for their durable global pricing power. Most of these companies that we are highlighting have incredible scale. They're available in 180 to 200 countries, strong pricing power, non cyclical nature, and very low debt and very strong balance sheets. That's the reason why we love them. They are they have cash cow, generally inelastic demand, still high margins. High margin is of course relative. For us, 30% high margin is margin enough. Some companies 20% high margin, as long as those are high operating margin. Okay, so differentiated products in general, because people have grown accustomed that when it comes to chocolates, if you're used to eating Hershey's or Milky Way, you're gonna be patronizing those same brands, just like how you patronize Kit Kat, Reese's, and so on. So most people again assume that Coca-Cola and Pepsi are just one product companies, but the reality is that, for instance, Pepsi, they actually have more than 23 already, a bit more than multi-billion dollar brands, i.e. They're selling $1 billion and more of Diet Pepsis, Diet Mountain Dew. So you really have huge multi-billion dollar brands, over 40, 250 million, close to $1 billion brands. So these are really powerful companies. I actually started nibbling on Pepsi. I understand that people will dollar cost average on them. And in general, if they fall 10 or 20% lower further, I do think that you have an opportunity that is really remarkable that you should take advantage, because I do think that the Fed cannot raise rates to the point of making the economy break down. So you will not have the Fed actually raising, in my view, at 7 or 8%, detrimental to further downside to these consumer staples, just in case. You can see that that's for Pepsi. Now for Coke, you've got a lot of number one leadership positions across ready to drink, energy, sports, ready to drink tea, water, sparkling juices, and so on. So you've got a lot of categories for the beverage category. Lots of choices, calories optional. What most people think is that Coca Cola is a sugary drink company, which is true, but there are also a lot of choices, and you can actually have companies that have less calories if you so wish. Okay, so you also have to understand that the reason why we are highlighting this consumer staples or recognizable brands, some of the top 25 most chosen brands in the world. Number one has been Coca Cola, Colgate Palmolive. Number two, Maggie. Number three, you'll see that Maggie is in the Unilever, for instance. And then you've got Unor, which is in the Unilever. Lace is in Pepsi. You've got companies like Lifebuoy. Then you've got Sunsilk, Dove. So you're seeing actually that most of these 25 top brands, these are some of them are actually selling off nowadays, which are interesting to us. Take note as well that when we say that you have the illusion of choice, we literally mean it, because when you talk about the top 10 most valuable soft drink brands, they're actually all owned by Coca-Cola and Pepsi. Then when you look at top 10 most valuable food brands, they're also just within a handful of companies. Tyson's number five. You've got Nestle, you've got Danone, you've got Chinese companies here. And then you've got Wrigley, Lay's, McCain, Kellogg's, Kraft. Kellogg's actually got spun off recently, so that's also interesting. When you take a look at best global brands, you're seeing that recently you have some huge sell-offs, which we believe are interesting buying zones as well. For Disney, Nike, McDonald's, Coca-Cola, and Louis Vuitton. Recently, LVMH was also falling about 30% from its peak. Might be actually an interesting buying zone sometime within the next few months. High quality dividend assets that are currently selling off, in our view, is a value play. So Pepsi is actually trading currently at the 50-day monthly moving average. So it's actually already trading at the 250-day average. And if you take a look at it for the last 10 years, this company, Pepsi, one of the things that we like about Pepsi is that it has, as Ali said, they're all paying dividends. Pepsi pays right now $1.55. That equates to about nearing 3+% yield. Now we think that this company, oh, sorry. Pepsi is paying $5. Sorry, the $1.55 is in another company. I mixed it up. But Pepsi is trading with $5 dividend a year. So, of course, you may want to get it at $100, but I really think that there will be a lot of demand coming in from 160 to 125. So around these zones, you want to start dollar cost averaging with more buying volume if it ever nears close to 120, and even really just keep on cost averaging if Pepsi even drops to 100. I don't think that the recent narrative about weight loss drugs impacting consumers is really gonna have a detrimental impact on Pepsi sales going forward. If at all, it's already being priced in on these sell-offs. You're seeing Coca-Cola also dropping so far, 23% from its peak at 70, currently trading at 50. During the pandemic, there was a huge drop here towards $35. However, I don't really think you can get an entry at 35. Try starting at 50 to 45 area for Coca-Cola. So last night, if you look at the entire week, the S&P 500, you've got the packaged foods like Kraft Heinz down 4% for the week. General Mills stable at down 1. Hormel is down big, down 12. McCormick is at $60 below. It's now 9% down. You've got Lamb Weston, which is potato chips, French fries, down 14%, serving a lot of casual food restaurants. You've got yeah, so interesting drops on these, no, big drops on Hormel, big drops on McCormick Spices, very huge drop on Lamb Weston. Um, Walmart, the reasons of the bears. Walmart says users of weight loss drugs are buying less food. Hormel sinks amid largest wage increases in meat packers' history. So you've got people questioning whether Hormel will have rising sales over time or will just be flat to down. So again, in case you want to check, Hormel has had sales last year, 2022, of about $12.5 billion. And it is a leader in 40 plus retail categories. We actually have in our Awesome 10X, ideas profile is Hormel Foods, the spam legacy and world class brands. For those who are in the membership, you can check this class, spam Hormel Foods. Um, so we really wait. Let's check if I can share that. Stop screen. Let me present and share. Okay, so check out this. So Hormel Foods has been killed last night. And it's interesting because it is a portfolio of strong names. So you've got these brands, Planters, Skippy, leading in the marketplace. Their brands hold number one or number two position in more than 40 categories. And approximately 86% of all the households in US are purchasing products sold by Hormel Foods. So you've got Spam, as I said, their flagship product. And then these companies, powerhouse brands, right? So it's a lot of meat. You have a lot of charcuterie, and they have a lot of retail, and then food groups, operators. No, so these are their food groups. So it's really, and then of course they have expansions in China. They have a lot of Chinese here, Jiaxing Hormel Foods, which is an innovation center in China. They have these three main divisions: the retail, the food service, and then the international. So these are the sales, 12.5 billion. You've got dividends paid out yearly for Hormel Foods of about $1. So at about $30, you have 3% yield. I think that 3 to 4% yield is gonna put in a bottom in these companies because they continually raise their dividends over time, as much as 10% raise on dividends over time, as you see here. This is Hormel Foods annual dividends over time from 2012 to 2022, starting from 30 cents to about $1. So, I mean, treasury bonds will not keep on increasing rates over time, but companies like consumer staples who can continue growing their earnings and their sales can actually do that for you. So, over time, I do believe that um, even at a lower PE ratio, definitely, of course, at $30, the PE ratio is already less than 20. And even if you assume that earnings will fall, then that is even a more attractive buy. So we're looking really at Hormel Foods already in the buying zone. Okay, let's show to you more things here. The news essentially of why Hormel Foods dropped is leadership from the union stated that the contract provided the largest wage increase in the company's in history, with an hourly increase of about $3 to $6 per hour. So meat and poultry division will actually get their earnings killed because of this, and that's the reason why even a drop from 40s to 30s are sending people to a panic sell. We view that a panic sell. Your S&P 500 year on year is actually up 20%, whereas Hormel Foods is down 30%, and it could fall further more. And if you take a look on Hormel Foods over the last 10 years, you can see that the S&P 500 is trading 200% up, and Hormel Foods is now just up 122%, actually comparing it near that 2017 area. So there's significant mean reversion that's possible, given the fundamentals of Hormel Foods is not an underperform versus the S&P 500 companies. So of course, this is still a very good quote to remember. In bull markets, stocks will not go down on bad news. In bear markets, stocks don't go up on good news. So right now, with an absence of good news, there is a likelihood that that sorry, nowadays you have quite a lot of bad news, and what you're gonna wait for is if Hormel Foods will stop going down. First and foremost, you have to wait if Hormel Foods or consumer staples will start their bullish run sometime within the next 2 months. So you're in a bottoming out phase here. Another thing to share, Conagra stock hitting its lowest level since year 2020 as consumers are growing cold on frozen food, we are really hearing that many people are starting to stop buying these frozen foods because they are one meal per person instead of for sharing. So that is just really another oh, it's okay. How should I say this? Wait, where was I? So we're seeing actually that the companies are getting like Canagra is getting hit low because of the assumption that Americans are, of course, cash strapped, and so they are buying more of canned goods that are for meals to share rather than for individual. So these are the Conagra brands. If you take a look, they have the Chef Boyardee, they have Libby's, they have Hunt's, no condiments and enhancers. So you've got snacks and sweet treats. I think that the frozen meals like Bird's Eye, Bertoli, they're getting a lot of decline so far, and that's 45% of sales. So that's affecting Conagra brands. We agree that there are reasons to be wary, but again, the share prices are already hitting we're seeing that those news are getting priced in quickly as well by the stock. Let's show you Conagra brands. So you're seeing that Conagra brands is falling from $40, $39 towards 26. So it's already dropping towards back to the 2020 COVID lows of $24. So interestingly, we saw that these have been the bottom also on the last 10 years at about 24 to $23. So Conagra brands is also approaching some indiscriminate selling in our view as well. Okay, are you able to see that? Let me see if that's if you were able to see my screen. Wait, present share screen. Yeah. So Conagra Brands, interesting company as well in the buy zones in our view. Now I'm gonna share this tweet by Stock Market News. All these stocks have hit new 52-week lows at some point today. American Airlines, Southwest Airlines. For that, I think it's still because of oil, so we're not really looking at that yet. Clorox, JD, Dollar General. So far, amongst these, I've been looking at JD. I think JD is interesting with $24 per share. That's also trading near the 2014 lows. So that's actually a very value play considering that it's still the second largest e-commerce powerhouse in China, and that still has moat with one of the best logistics warehouses in the entire China place. Yeah, so that's interesting. So far, I will admit that I haven't read on Clorox, but that's also something that I am looking at. You've got so many companies trading at 52-week lows recently. What we have been studying has been Hormel Foods, Hershey's, but you also have companies like Keurig Dr. Pepper, Kraft Heinz, McCormick Spices, JM Smucker, all falling down, Campbell Soup, British American Tobacco. So then Dollar General is also trading low. Again, Dollar General is, I think, also an interesting stock to study because that company has more than 18,000 locations competing with Walmart, obviously, but getting killed with most American consumers having difficulty to stretching their dollars. No, so there's really a lot of interesting stocks recently. JD is trading at $28. It got killed last night, down 8% because of multiple downgrades. What's notable is that if there were downgrades, most of the target prices are significantly higher than current levels of 28. Most of the target prices are even as high as $80 for JD. So it's actually trading near its 2014 lows or 10-year lows at $20. So just a few gun shy, but this one is interesting on in my view. Hang Seng Index has been crumbling 385 points last today amid weakness in technology and consumers. JD crashed 12% today in Hong Kong. And I would share this tweet by Johnny, which is JD is looking to be a forced liquidation by a fund or a margin call. Once their selling is over, they believe or we believe that it will pop up again. It's one of the cheapest Chinese retailers today. $24 is actually the cash per share. It's trading at one times book value or even less, no? Yeah, so this one is an interesting company in my view, JD. That's been getting sell-offs. Then you can see the downgrades. Some companies are giving downgrades, but notice most of the target prices are significantly higher than current levels of $28. Targets are 35, 40, 60, some even as high as 100 and 120. So this one is an interesting company. At least seven brokerage firms have either downgraded the stock or lowered the target price of JD in the past 2 days. Morgan Stanley reduced their call to equal weight. Citigroup cut their estimates by a third. All of them are talking about how the revenues will be for JD amidst the weak macro environment in China. I think these consumption downgrades are all similar to the same downgrades that has been happening for Domino's Pizza, Nike, Disney, Starbucks in China. So I argue that I agree with that slowdown in China, but it is also being priced in at the stock already versus companies like Tesla and Apple, which hasn't really priced in any of that slowdown from China either way. So JD has already more than halved this year. And heading into 4Q 2023, despite the seasonally strong November 11 promotion, a lot of the analysts in Citigroups are still cautious. I think that these are, it's warranted, but the downside is so small versus the upside. Another interesting to share the tweet by Jason Goffert. Why do lagging small caps matter? So I do believe that in a recession, the consumer staples that we are highlighting are gonna get a premium valuation. That's why while they're going down, like Hormel Foods, while Coca-Cola and Pepsi are falling down, while Hershey's and Mondelez are falling down, once a recession starts, they actually start trading at a premium. So, and if recession is more likely within the next year, then something to really, really nibble at is this. And also, when you have a recession, there's a high chance that the Fed will not rate hike, and they will likely pause. So, a pause on the Fed and on a potential recession is actually gonna make a valuation play for a lot of these dividend-paying stocks. Okay, so dividend paying stocks, Hershey's, we talked about this last week. You can check that topic. No tricks, only treats equals Hershey's, September 29. Check that out. I agree. I think this one is looking into the buy zone. Spices is life. We like McCormick. Hormel Foods, we like that. Mondelez is interesting for me as well. The owner of Oreo, Ritz crackers, a lot of the chocolates and biscuits category, candies. I like that. So I usually love them as a child, and I do believe that we are all also kids at heart, so we'll still continue to purchase all of these chocolates and biscuits, even as we're adults. So definitely there is a continuous demand for these types of companies. Mondelez International from 60s dropped to $40 last 2020, a 30% drop. Should Mondelez start dropping again towards 56, we think that that is a potential bottoming out in play or even a higher low or a retest of those lows. So watch out for these great companies happening. Consumer staples, I'm watching for buys. Tyson Foods, McCormick Spice, Coca-Cola, Pepsi, Hormel Foods, Hershey's. In terms of fast foods, the ones that I like already, Domino's Pizza 300, McDonald's, selection wise, yes, but I haven't checked the valuation yet. Perhaps I'll wait for McDonald's and Starbucks. McDonald's and Starbucks hasn't hit my buy point yet in terms of valuation, but I'm looking to buy them should they fall 10 to 20% sometime within this week or this month or next month or next month. Consumer discretionary also on my watch list is Nike and Disney. We've seen Nike already bounce at 90, Disney already also been bouncing at 80. So these two, Nike and Disney, for consumer discretionary stocks, already got hit hard. So I think they're trading a bottom or bottoming out range. Okay. So we have these company profiles for those who are in the Awesome 10X group. Check out these names: Safety Stock, Discounted, Pepsi. Check investment modes. We want to buy companies with investment modes. We want to buy companies even in the utilities that are also under pressure. So right now in the sectors, a lot of the utilities and the staples are taking a huge beating. Utilities are close to 20% down this year. You've got staples close to 10% or more this year. So those are the ones that, in my view, are setting up for some interesting buy zones. So yeah, that's it. Thank you very much. And for those who are actually, I think that nobody could have predicted that these consumer staples will well, actually, I know that they are expensive, but it's only now that they are trying or getting a cheap valuation. So it's really really a good time to start checking on consumer staples. If you have time, those are the stocks to put in your watch list. So we repeat, put in your buy zones or your shopping lists: Coca-Cola, Pepsi, Tyson Foods, Hershey's, Mondelez, McCormick Spices, and Hormel Foods. That's it. Thank you very much. Bye bye.